Greetings. In this video, you will learn about journal entries and how to record them. What is a journal entry? Journal entry is a way of recording transactions in the journal ledger or set of accounts. If you remember, every business event is a transaction. It can be sales of goods or buying goods or paying for electricity or any other bills. Accounting is based on double entry system, which means that every event or transaction impacts on at least two accounts. So in journal entry, you will have minimum of two accounts. Before recording a journal entry, you need to think about what is it that you are recording. You need to analyze that transaction. You need to remember your debit and credit accounts. Just a refresher, debit accounts are expenses and assets. Credit accounts are income, liability, equity, and provisions. Before we get into recording of a journal entry, you need to know that accounting is based on historical transaction. So in a history book, you see date, you see what was happening, you see who was involved and what was the impact. All these things are also recorded in a journal entry. So when you are analyzing the event which has happened, you need to say what were the accounts involved, how much was the value of the transaction, and of course when it happened. You need to know the accounts which are involved in this transaction. Are they debit accounts or the credit accounts? Is their balance going to increase or decrease after the transaction has happened? This will help you in deciding which account to debit and which to credit in the journal entry. Now there is a simple transaction I would like you to say. Jane Smith spent $1,000 to buy a computer on 1st of April. Now there is cash involved, so she paid cash. She bought a computer, so there is computer involved, and then the date of the transaction is 1st of April. Now just to revise what we talked about, date of the transaction is 1st April. Jane paid $1,000 and she got a computer. Now the accounts involved are cash account and the computer account. Type of these accounts is asset. Both of these accounts have debit balances because we know assets have debit balances. Now one account is decreased. Cash account is decreased because she actually paid the cash, and one account is increased. Computer account, she did not have any computer, but now she has bought the computer, so the balance of that computer account is increased. From there, you can identify that computer account is going to be a debit in the journal entry. And because cash is decreased, it's a credit in the journal entry. So just a revision, date, description, debit, credit amounts, narration. And this is how it's going to look like. So on 1st of April, computer account was debited. The balance increased by $1,000. Cash account was credited and the balance was decreased by $1,000. When you credit an account, you write it as to the account, name of the account. And in the last line, there is a narration, just letting the reader know what is this entry for. So we are entering the journal entry to record purchase of a computer. Now here's an example for you to try. Jane Smith sold a computer for $900 on 1st of January 2022. Let me know how you go in the comments below. Thank you very much.